The question of whether the United States can ever repay its national debt is one of the most pressing and complex challenges facing the country today. The public debt of the United States in August 2024 was around $35.26 trillion, a slight increase from the previous month. The U.S. finds itself in a situation that has been decades in the making, and there's no simple solution in sight. This staggering figure represents more than 120% of the country's entire gross domestic product, meaning the debt is now larger than the total value of goods and services the country produces in a year. The magnitude of this debt casts a long shadow over the U.S. economy, sparking deep concerns among economists, politicians, and the public alike. The debt itself is composed of two primary parts: public debt, which is money the government owes to external investors like foreign governments, corporations, and individuals; and intragovernmental holdings, which is the debt the government owes to various trust funds like Social Security and Medicare. In essence, a large portion of the national debt is money the government has borrowed from its own programs to finance other activities. This internal borrowing adds another layer of complexity, intertwining essential social programs with the country's overall financial health. One of the most frustrating aspects of this growing debt burden from a public perspective is the feeling that the country hasn't received anything significant in return for it. Unlike other nations that have accrued debt to build extensive social safety nets or modern infrastructure, the U.S. has neither a national healthcare system nor a fully funded pension system for retirees. Instead, Social Security remains at risk, public schools are underfunded, and the country's infrastructure, from roads to bridges to public transportation, is crumbling. Trillions of dollars have been spent, yet essential services remain underdeveloped or on shaky ground. For many, it feels like the debt has ballooned without truly benefiting the majority of Americans. The rapid rise of the U.S. national debt didn't happen overnight. It's the result of decades of government spending outpacing revenue. The United States has consistently run budget deficits, spending more than it collects in taxes and other income sources. The U.S. government funds this deficit by borrowing, issuing treasury bonds and other securities to investors both domestically and internationally. However, the gap between government spending and revenue has widened considerably in recent years, especially with the ever-growing demands of defense, healthcare, and Social Security programs. A large chunk of the federal budget is devoted to programs like Medicare, Medicaid, and Social Security, which combined account for nearly half of all government spending. Add in the military budget, one of the largest in the world, and you start to see how quickly expenses pile up. But it's not just a spending problem. A series of tax cuts, particularly for corporations and high-income individuals, have also contributed to the shortfall. The Bush-era tax cuts in the early 2000s, followed by the sweeping tax reforms under President Trump in 2017, which reduced corporate tax rates and altered individual tax brackets, further reduced government revenue. The hope was that these tax cuts would stimulate economic growth. But in reality, they left the government with fewer resources to cover its obligations. And then there are the economic crises. The financial meltdown of 2008, the COVID-19 pandemic in 2020, both of these events triggered massive increases in government spending as Washington scrambled to stabilize the economy. Trillions of dollars in stimulus spending were poured into the economy, adding significantly to the national debt. Additionally, wars, especially those in Iraq and Afghanistan, have cost the U.S. an estimated $6 trillion, further contributing to the nation's borrowing needs. At this point, the idea of fully repaying the U.S. national debt seems unrealistic. Few large economies ever truly eliminate their national debt, and the United States is no different. The focus isn't so much on paying it all back as it is on managing it. The U.S. government must ensure it can continue to meet its debt obligations, interest payments, and the rollover of maturing debt, without triggering a financial crisis. Thanks to the global demand for U.S. Treasury securities, which are seen as one of the safest investments, the U.S. has been able to borrow at relatively low interest rates. Moreover, because the U.S. issues debt in its own currency, it holds a unique advantage. Technically, it could print more money to pay off its debt. However, this comes with its own risks, namely inflation or even hyperinflation, which would destabilize the economy and erode public trust in the dollar. The immediate challenge is not necessarily repaying the debt, but servicing it. In 2023, the U.S. government was spending over $500 billion annually just on interest payments, a figure that is expected to rise as interest rates increase. The Federal Reserve has begun raising rates to combat inflation, but higher interest rates also mean it becomes more expensive for the government to borrow. If the cost of servicing the debt becomes too high, it could crowd out other important areas of government spending like infrastructure, education, and defense. This could lead to difficult decisions about what gets funded and what doesn't. To truly get a handle on the debt, the U.S. would need to focus on economic growth. If the economy grows faster than the debt to GDP ratio will fall, making the debt more manageable. There is historical precedent for this. After World War II, the U.S. had a debt to GDP ratio of over 100%, but the post-war economic boom helped reduce the ratio over time. Strong growth, combined with moderate inflation, can make debt easier to manage because it reduces the real value of the debt relative to the size of the economy. But achieving the necessary level of growth today is not guaranteed. The U.S. faces slower population growth and less dramatic productivity gains compared to previous decades, making it harder to grow out of the debt problem. Even if growth were robust, the U.S. would still need to reduce its annual budget deficit. This would mean either cutting spending, raising taxes, or some combination of both, each of which comes with significant political and social challenges. Cutting spending is easier said than done. Major programs like Social Security, Medicare, and defense are politically untouchable. These programs have strong support from the public and powerful constituencies that make reforming or reducing them a near impossibility. Meanwhile, raising taxes, though a logical solution, is equally controversial. Tax increases are deeply unpopular, particularly among conservatives and the business community. Yet without reforms to the tax system, such as closing loopholes or increasing rates on high-income earners, the government will struggle to raise the revenue needed to cover its obligations. One potential solution, as Warren Buffett famously quipped, would be to pass a law that ties politicians' fates directly to the health of the nation's finances. I could end the deficit in 5 minutes. You just pass a law that says that any time there is a deficit of more than 3% of GDP, all sitting members of Congress are ineligible for re-election, Buffett said. While his remark may be partly tongue-in-cheek, it underscores the real issue: the lack of political will. The gridlock in Congress has made it nearly impossible to pass comprehensive deficit reduction measures. Both sides of the aisle are deeply divided on how to tackle the problem. Attempts to reform entitlement programs or raise taxes are often met with stiff resistance, making compromise elusive. So, what happens if the U.S. doesn't get its debt under control? In the short term, the country can probably continue to manage its debt without too much trouble. But in the long term, the risks grow. As the debt continues to increase, so too will the cost of servicing it. Rising interest payments could consume an ever larger share of the federal budget, leaving less room for other priorities. This, in turn, could lead to slower economic growth, as less investment is made in infrastructure, education, and other growth-promoting areas. Moreover, if the debt continues to rise unchecked, it could lead to a loss of confidence among investors. While U.S. Treasury securities are currently viewed as one of the safest investments in the world, that could change if investors begin to doubt the U.S. government's ability to manage its finances. A loss of confidence could lead to higher borrowing costs, further exacerbating the problem, and in a worst-case scenario, it could trigger a financial crisis. In conclusion, while the U.S. is unlikely to ever repay its entire national debt, the focus will be on managing it in a sustainable way. This will require a combination of economic growth, fiscal responsibility, and, crucially, political courage to make the tough decisions needed to rein in deficits and stabilize the country's financial future. Without meaningful action, the national debt will continue to cast a long shadow over the U.S. economy, limiting future growth and leaving the country vulnerable to economic shocks. The frustration lies not just in the sheer size of the debt, but in the feeling that the public isn't seeing the real benefits for all the money spent.